The worst year for corporate bankruptcy since the global financial crisis will be 2023. This year saw the two largest American bankruptcies since the GFC. Don't worry if this makes you nervous. The numbers indicate that 2024 will be even worse. Standard & Poor's reported a 200% increase in significant company business bankruptcies in the first half of 2023. WeWork, Vice Media, and Bed Bath & Beyond all failed due to poor management, shifting consumer tastes, excessive interest rates, and poor market conditions. But what does this mean? Despite the fact that these companies are bankrupt, Vice continues to produce videos. WeWork rents out offices, and Bed Bath & Beyond sells pricey laundry hampers. Bankruptcies have evolved. It's no longer a corporate game over, it's just another business plan. One of 4 reasons it's so popular. The other 3 reasons for the rise in bankruptcies, on the other hand, are concerning and demonstrate why business leaders no longer take it seriously. The main reason for the rise in bankruptcies is a new financial strategy that encourages risk-taking. Private equity investing entails investing in non-public companies. Venture capitalists use private equity to invest in early-stage startups. All Shark Tank transactions are private equity. You are a private equity investor if you give your family members a few $1,000s to start their Etsy store in exchange for half of their future earnings. Buyout funds are private equity funds with real money. These firms buy entire companies with billions of dollars from college endowments, retirement funds, and wealthy investors. Their investment theory holds that astute fund managers can use their business skills to improve the companies they buy in order to reduce expenses and increase revenue. According to Benjamin, the genuine investing plan is becoming completely jacked up on debt they don't have to pay. It works like this. Consider yourself a private equity partner with $1 billion to invest. You come across a promising company that requires your business skills to succeed. Let's call it Grandma's Pies. You hire a CEO you trust to carry out your orders after buying the company with your $1 billion. The CEO's first task is to secure a large bank loan or investor loan for Grandma's Pies. If the $1 billion corporation is profitable, it should be able to borrow $700 million. Give your CEO one of 2 options for that money. First, tell them to advertise, open more locations, or expand online. You can also demand that they pay you the $700 million as the firm's owner. If you chose option 2, you can use the money to buy another firm and repeat. This is a leveraged buyout. Private equity investors make something appear complicated in order to charge high fees. With 2 minor exceptions, it's similar to real estate investors using funds to refinance or purchase another rental property. The first distinction is that they buy businesses rather than real estate. Second, unlike a mortgage, the private equity firm is not liable for Grandma's Pie's unpaid obligation. As a private equity investor, convincing your CEOs to take on as much debt as possible is a good strategy. Turning around businesses allows you to quickly quadruple or quintuple your investment. Even if an enterprise fails due to debt, only 20 to 30% of the money invested is lost. Because it could deliver big profits while limiting risk, the leveraged buyout strategy was used to buy hundreds of popular names at low interest rates. The prime commercial debt rate tripled. Many corporations are unable to pay because of trillions of dollars in debt, though this will harm lenders and employees of the private equity firms that caused the problem. It will be a great profit opportunity for reasons that may be hard to believe. These bankruptcies can increase their profits. Famous corporations rarely declare bankruptcy in the United States and around the world. According to Bloomberg's aggregated bankruptcy files, the number of small to medium-sized businesses that have permanently closed their doors has increased the most. Although small businesses are always risky, the types of organizations that go bankrupt may surprise you. According to the Small Business Association of America, companies with $1 million to $40 million in revenue and 100 to 1,500 employees are classified as small. According to U.S. Census Bureau, some of the failing small businesses are large and employ over half of all working Americans. According to the report, major corporations such as Bed Bath & Beyond, Amazon, WeWork, and Walmart employ 23% of all Americans. Small business bankruptcy has less impact than large firm bankruptcy, despite the fact that they are more significant collectively. The only reason no one is more concerned is that bankruptcies are increasing. It's past due. Despite difficult market conditions, firm bankruptcies fell to a record low in 2021 and 2022. Despite poor management, government programs such as paycheck protection loans and low interest rates allowed businesses to borrow to offset expenses, and thus few failed. Without these conditions, these businesses would have failed long ago, hence the moniker zombie companies. Repaying these loans carries a higher interest rate. Small business loans, unlike fixed-rate mortgages, have adjustable rates, which means interest payments can change to reflect market rates. Mortgage repayments have an impact on budgets in other countries because adjustable rates are common. Fortunately, Fannie Mae and Freddie Mac protect Americans from this. Our businesses aren't so fortunate. According to Moody's, $1.87 trillion in junk corporate debt will mature between 2024 and 2028. This is an increase of 27% over last year's study of $1.47 trillion. Because Moody's doesn't track Paycheck Protection Program loans, this figure excludes $953 billion in additional salary loans to employers. According to CBS data, loan forgiveness totaled $757 billion. Although businesses are not responsible for these repayments, they can no longer rely on them. Many of you are watching this video working for small businesses that are responsible for much of the bad debt. As this debt matures, more businesses are going bankrupt due to financial constraints. This is a major concern for you, the worker. The third reason for the rise in bankruptcies is that businesses can survive bankruptcy. It may be a new beginning. The distinctions between personal and corporate bankruptcies create one of the most frustrating business situations. After their companies fail, CEOs and executives frequently receive millions of dollars before shareholders, creditors, and even employees. Although illegal, this occurs frequently. To understand how this could happen, you must first understand that bankruptcies vary. The convenience store Duo has filed for Chapter 7 and Chapter 11 bankruptcy. Monopoly is analogous to Chapter 7 bankruptcy. Stop operation and company assets are liquefied first to pay stakeholders. Secure creditors, such as banks that lend against property or equipment, are given priority over priority creditors, such as clients who held money on account with a company and employees. Following that is the payment of unsecured debt holders. Following that, any remaining funds are divided among stockholders. Non-voting preferred stockholders at Berkshire Hathaway and Meta receive money first. No money is released to the next person in line until the top priority creditors are paid, resulting in a waterfall or liquidity overflow. The CEOs who caused the company's problems are the exception. Companies pay CEOs and top executives millions of dollars to guide them through liquidation, because senior management can maximize stakeholder value by keeping things running until they are sold. You can't turn off the lights and hand over the keys to the auctioneers if you run a pharmaceutical company into the ground as CEO. Potential buyers only value medical research and labs if they can be properly transferred. However, as a cruel business tyrant, you'll want to know the advantages. Because you are second in line, a bankrupt company may not pay your wages. They might bargain because you can help customers get their money back. A one-time payment to stay until completion. If corporations did not do this, CEOs would immediately resign and look for new opportunities. The most infamous example of this was Enron, a massive business bankruptcy caused by unscrupulous executives who were paid millions to save the company. Congress passed legislation prohibiting executive retention bonuses. However, Columbia Law School Associate Professor Robert Jackson claims that they left a legal gap. Performance-based rewards for managing the bankruptcy they created are legal because they are not retention bonuses. Another type of bankruptcy, Chapter 11, necessitates the use of this loophole even more. This type of bankruptcy appoints a court-appointed administrator to work with company executives to recognize finances and operations to pay back as much debt as possible, while maintaining the business's strength to continue making money. Even though Vice is in Chapter 11 bankruptcy, it continues to produce videos because they are profitable. Chapter 11 filings are increasing because now is the time to negotiate debt. Lenders prefer something to nothing and do not want to panic. Even if corporate credit scores suffer, businesses will not borrow money at such high interest rates. The fourth reason for the rise in bankruptcies is that businesses have learned to conceal their operations behind layers of holding companies and trusts. So what are your thoughts on all of this? Let us know in the comments below. As always, thank you for watching, and don't forget to like and subscribe to stay up to date in the world of economics.